Maneesh Dangi, founder of Mosaic Investing and Research Johnson, right now on the show to talk about his thoughts. Manish, so good talking to you. Neeraj here. Good morning. Thanks for taking the time out. It's been a while, so I'm really glad we're having this conversation. I'll start off by asking you, Manish, about how do you view the current investing landscape from your prism? The tariff issues are not resolved. Will the markets learn to live with them, or is that a big overhang? Couple that with maybe earnings growth looking iffy, global economies having issues of debt, particularly the UK and a few others, and at the same time we've got hard assets doing really well. How do you fit all of these in together and take investing decisions?
Morning, Neeraj. So many things. I guess let's start from inside out first. Local macro seems all right. I think regulatory easing is underway in India. Pretty much all the tightness since 2016 by RBI is in unwind. A GST cut, of course, is of course a great news. At margin, consumption should improve. I would argue at least 40-50 basis points should add to the GDP. So local conditions seem all right. Of course, we can continue to argue why investment is not picking up, but all engines don't fire. Geopolitically, I think, and I would argue here, and no one knows, frankly, that how Trump tantrums would play out strictly. But my sense is that the peak stress there is in. Trump also would pivot to its local politics because March, April, you have midterm elections there. So I guess, either the peak geopolitical stress is in or it's about to fade in next 1 or 2 months. So by November, December, almost for sure, I think geopolitical stress should begin to fade. It has faded for most countries. We and Brazil have been singled out, unfortunately. But generally, I think I would argue that if you were a market practitioner and have to gauge as to how things will play out, geopolitical stress would begin to fade. So that's purely macro. If you were a pure macro investor in India, you would begin to think that at margin things are improving purely from an equity standpoint. I think the problem is, of course, that the core engine of India, equity is not firing, and which is earnings. It's going through its cyclical downturn. It's been 2 years already, and my sense is that it's going to sustain for a while. Likely because nominal GDP growth is sort of growing only 8, 9, 10% now. So how it's very difficult for the revenues to grow, and margins are so high that it's very likely that they will actually roll over instead of actually going up from here. So in a sense, a little bit of a muddy outlook, Neeraj. Few things sort of looking good, few things still sort of not recovering.
Manish, and you think of this so deeply. So when I hear you say that earnings may take a while to improve, I believe that's what your base case is. How long is this while? Is this, and it may change, of course, but in your base case, does this last for another 18, 24 months?
I would suspect so. At least in the there's absolutely nothing substantial that I can cite, Neeraj, that will drive earnings higher. See, essentially, either nominal GDP starts to accelerate, because that relates very well with revenue growth, and thereafter, of course, comes profit growth. So my sense is that would nominal GDP growth accelerate from here? I would argue against it, that likely that inflation will remain muted, and growth, even though we are not collapsing, we are not almost certainly accelerating as well. The other part of the earning growth perk up can happen through margin expansion And there, actually, I would argue that margins for the given nominal GDP growth is so high that they will actually roll over. They will actually come down, and that sort of remains a risk, at least in near term. Indian margins, actually, unlike most emerging markets, have not come off quite substantially. So I'm not even talking of a lot of stress from Trump tariffs in IT and exports and stuff like that. Even though all of these I think will improve, I don't think that margins sort of, I see them improving. So both the sources of profit growth are unlikely to be there on the horizon, Neeraj, anytime soon.
Manish, Hiral, coming in, you also mentioned about India, which has already entered a cyclical slowdown, which will probably last for the next couple of months from here on. You're talking about the earnings, the visibility that you have so far. You have always consistently had a cautious approach when it comes to equities and a bullish view then coming in when it comes to bonds. What should the strategy then be between equities and the bond market right now that could then deliver attractive returns to investors?
See, here, if attractive means it means the way it's assumed, sort of by most investors. I'm afraid, it's neither in bonds nor in equities you're going to have bombastic returns. Bonds in the end, 10-year bonds have rallied quite substantially. Uh, I continue to make this relative argument, as I've made on your show for the last 1.5 years, that even today, at lowish yield, bonds may actually over deliver versus equities, given the stress in equity, mostly from a valuation standpoint. And which would mean, maybe bonds will deliver at 6.5% bond because there's going to be some rally. Bond yields will come off. They might deliver about 8% or 8.5% over the next 12 months or 18 months. So in a sense, a composite of debt and equity over the next 3 years and let's say it's a 60-40 portfolio, 60% equity, 40% debt, unlikely that it will deliver even double-digit return. So investors should sort of prepare themselves for a lot lower return. The excitement in the market that we saw between 2023-24, I think should fade, and at margin, you should prepare for much lower return in general. At margin, if you're an asset allocator, of course, there is a case to make that bonds perhaps you should be somewhat overweight on bonds versus equities, because equities are likely to underperform and not deliver the risk premium they promise to deliver generally for the investors.
Okay. And Manish, within equities as well, would you still take shelter under the BFSI space? Because that's something that you have been speaking about with all the quarterly updates that have come in over the weekend, I think whole host of them. And the RBI monetary policy also came up with a couple of, measures from here on. Would this package tell you that, yes, this is the time to start looking at BFSI and start nibbling in?
So yes, I agree to. I think everyone now, sort of a reasonable manager, argues for BFSI. It's decently valued. The local policy at margin, of course, is fairly relaxed and should support the private banks, public banks both alike. And so my sense is that, yes, that cohort, should do reasonably well. I think the other piece which in the market could really do well is IT. And my argument is there that, there is no way to be bullish on India without being bullish on IT. It's difficult to argue that IT will flounder and yet India and Indian markets will do well, particularly in the context that IT as a percentage of overall market cap has already fallen to 14-15-year low at 8% now, which was 14% of the overall market cap. So my sense is that if you want to be constructive in India, the path to get there is actually through IT, and to that extent, I think that should be the part of overweight portfolio of yours. Almost everything else in India, even in large cap space, is actually crazy expensive, including FMCGs. And of course, in mid cap and small cap, so everything is expensive. So I think these are the two places, IT and BFSI, through which I would play the regulatory easing and better macro, along with, of course, the precondition of being bullish on India is IT. So these are the two sectors that I think it should be part of investors' portfolio as overweight.
Manish, the the other question is the worry on the in fact, I mean, either the worry on the currency, if you will, or is it just a normal balanced downtick that you foresee, and will it correct itself? Any thoughts here?
Neeraj, on the currency, the fundamentals have improved in India. The current account deficit now tracks at just about 0.5%. So the traditional concerns with respect to currency that we would depreciate is because economies used to overheat, our inflation used to be higher than US, along with, of course, high current account deficit would force our currency at margin, every now and then to depreciate. That concern has sort of totally faded. So I think the stress in currencies right now largely speculative, driven by FIFDI, which I would say is somewhat speculative in nature. There's no fundamental reason why our currency should depreciate, especially in context when dollar itself is very, very weak. It's depreciated by 10% year to date versus other major currencies. And so it's a sort of a news-driven, BOP-driven, largely flow-driven trade that has played out in currency. If you sort of take a little bit of a longish view, and investors can think of taking a 3-5 year view, I would argue that Indian currency would be decently behaving. I don't think some of these significant depreciation should take place in terms of run rate basis over next 3-5 years, because as I said, a large part of the currency, at least in the medium to long term, is driven by how your current account deficit and inflation differential is, and both seem to be in real good shape. We haven't seen such low inflation differential and such low CAD for since you and I have been born, I would argue, that and sustainable, so to say. And that's a very, very good news for currency at margin, at least for medium to long term.
Okay. My last question, Maneesh, coming to you is consumption as a theme. Again, something that you like. Taking all the reforms, the benefits into consideration from a domestic point of view, the festive season which is here, the commentary that we've been hearing from OEMs, and if you have to talk about the consumption pack as a whole, are valuations supportive right now to dip in, and would you be a buyer?
So I actually okay, we'll quickly try and explain. Within consumption, for medium to long term, it's only the luxury consumption or the discretionary consumption which should actually do well. Because population growth has slowed at margin and would continue to slow, fewer children are born, and all of that should mean that the staple consumption in India will continue to stay sort of mutish. Indian consumption basket is very, very expensive. So even though you want to be bullish on consumption at margin, and this tend to be a little bit of a defensive place to be in, the consumption is very, very expensive. So I kind of think that the better way to play Indian consumption is through the local tech. These aggregators, which actually sort of our bridge to the consumer between, so it's a B2C, B2B bridges. They are better ways to sort of play consumption in India. The pure consumer basket is very expensive, and the growth there is going to be, at least in near term, pretty mutish. And staples, for long term also mutish. So I'm not very bullish. But if you were an asset allocator and you were to think between consumption versus investment, likely that rural consumption is a better place to hide versus investment, where there are absolutely no signs of green shoots even now. And they are very, very expensive as well. So answer to all of these is sort of diverse, both Hemal and Neeraj, as you know, and I more likely have confused you with all that I've said versus because there are no clear answers for anything. It's sort of convoluted and many orders at it.
But good to hear all facets, and which is why we love these conversations with you, Maneesh. But out of time right now on this show at least, so take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time.